A lot of dividend investors spend 90% of their time looking at the stock price and 10% obsessing over the dividend yield, but I am sure that you are not one of them. In the FIRE community, our goal is to quit our jobs and live off our assets for 30 to 40 years. That means the companies we own must survive. Today, I'm going to show you how to read a balance sheet in under 6 minutes. I'm going to give you the 3-step stress test that tells you if a company is a fortress or a house of cards. Let's dive in. Act 1. The golden equation. Think of a balance sheet as a snapshot in time. The formula is simple. Assets equals liabilities plus equity. Assets are the good stuff: cash, buildings, inventory, and patents. Liabilities are the bad stuff: debt, unpaid bills, and long-term loans. And equity is what is left for you, the shareholder. If you want to retire early, you want companies where the good stuff, the assets, is much higher than the bad stuff, the liabilities. If liabilities are higher than assets, that company has a negative equity. In the FIRE world, that is a massive red flag. If you pay attention to this, congratulations, you have left the gambling table and entered the world of investments. Now let's move on to step 1 of the stress test, the current ratio. This ratio tells us if the company can pay its bills over the next 12 months. Take total current assets and divide it by total current liabilities. If the result is less than 1, the company technically does not have enough cash or liquid assets to cover its upcoming bills, like is the case here with Fubo TV. Even giant companies like Apple could have a current ratio below 1. It doesn't necessarily mean that they would go bankrupt, but at least it gives you a watch out as an investor. For a safe FIRE portfolio, I look for a ratio of 1.5 or higher. This means that they have a 50% safety buffer to handle a market crash or a bad quarter without breaking a sweat. Step 2. Debt to equity. This is the most important number for long-term safety. Some companies look profitable, but they are drowning in high-interest debt. Take total liabilities and divide it by total shareholder equity. If this number is under 1, the company owns more than it owes, and that's a fortress. If it's over 2, they are heavily leveraged. In 2026, with interest rates being where they are, high debt is a silent killer. When debt comes due and needs to be refinanced at higher rates, that safe dividend you're counting on for retirement is usually the first thing to get cut. Step 3. Cash and cash equivalents. This is my favorite part of the balance sheet. This is the company's emergency fund. When a recession hits, companies with a mountain of cash like Apple, Alphabet, Microsoft, or Broadcom, they don't just survive, they go on offense. They buy up their smaller competitors for pennies on the dollar. When you see a company with a growing cash pile and shrinking debt, you have found a winner that can support your lifestyle for decades. Reading a balance sheet isn't about being an accountant, it is about being a detective. Your job is to find the clues that prove a company is healthy enough to pay you for the rest of your life. Here's some homework. Pick one stock in your portfolio right now. Go find their current ratio. If it's over 1.5, type stress test passed in the comment section. If it's under 1, tell us which stock it is so we can all take a closer look. If you want to see how I apply these rules and other rules to a real-world example, watch my analysis of Starbucks in the link in the comment section. I'll see you in the next one.